Hello and welcome to the Friday interest rate update. Mortgage rates were pretty steady this week, ending up at almost the same level as last Friday. It's always a big week when the Personal Consumption Expenditure, the PCE inflation report, is released, as this is the Fed's favorite indicator of inflation. This report can definitely be a market mover. Fortunately, there were not a lot of fireworks with this report. It came in pretty much as expected, which is always good to have, less volatility in rates. And as we've heard over and over and over again, inflation is typically the biggest driver of interest rates. When inflation goes up, interest rates go up. When inflation goes down, interest rates go down. The markets kind of anticipate which direction they're going to go, but inflation is key. So inflation has come down significantly since it peaked, but it feels like we're just like steady Eddie doing really nothing, and the declines are stalling out, and they're keeping interest rates at their current level. One of the key components of inflation is housing and determining whether rents are going up or down, because rents make up about 1/3 of the CPI, the Consumer Price Index, and about 1/6 of the PCE, the Personal Consumption Expenditure. These numbers can create a huge swing in what is actually going on. But here's the problem. The government surveys homeowners to get an idea if rents are going up on single family homes. They ask them this question, and it goes like this. If someone were to rent your home today, how much do you think it would rent for on a monthly basis, unfurnished and without utilities? I don't know about you, but I doubt I could come up with a figure for my own home. So I'm in the business, and a lot of people, when they get these calls, they just are guesstimating what their house could rent for, and combine that with many homeowners thinking very highly of their own home. Could they be overestimating this, increasing what actually is really not happening? And to think this is a question that could be driving the inflation numbers, it seems very archaic. And there are many other inflation reports out there, one of which is Trueflation. And Trueflation looks at about 10 million data points versus about 80,000 for the PCE. It is reporting only 3% housing expense inflation versus 6% as reported in the CPI. And this disparity in inflation, showing far less inflation than being reported, it really skews the numbers. So that said, I don't think the Fed is going to change their methodology anytime soon. So we will likely be stuck with some elevated inflation for the rents and the inflation rate. So we're in this for the long run, and I don't think we're going to see lower rates until the latter part of this year. So one thing that could change that is the jobs numbers. Those numbers come out next week, and those have been showing some weakness. And if they come out lower next week, then we may be able to jump back into the sixes, jump back down into the sixes. We'll see what happens. So as we have discussed many times, when interest rates do drop, more buyers will jump in to buy homes. It's not necessarily the interest rates that will drive up the prices. It is really the lack of inventory and the number of homes available for sale. Nevada leads the nation in the change of inventory from 2023 versus 2024. It is down over 27% in Nevada. And so prices are not likely to decline despite the high interest rates, and it will be hard to find a home when rates do go down. So get your buyers out there, keep them motivated. There is a window right now, in my opinion, while rates are elevated for home buyers to purchase. So until next time, hope you have a wonderful weekend, and let me know if I can help get your buyers pre-approved. We'll see you next week. Gaylord out. Bye-bye.